In this video trader, something I've been pondering for a while. Can we recreate the pit trader's edge on the screen? Stay tuned. Hey guys, warm welcome to you. All right, so I'm not going to string this along for a while. I don't think you can, and I'm going to explain in this video why that is. You might agree or disagree with me, but I don't want to waste your time with this. That's my conclusion, and I will talk to you why I think that's the case. So, pit traders, let's imagine a pit trader. How did a pit trader work? The pit trader used to be what was called a local. They would have a membership to the exchange, and their job literally was to facilitate order flow, like a market maker effectively. So if you came in as a trader and you're on the telephone to your broker and you wanted to buy 110 S&P futures contracts, big boy contracts in the pit, that would go down, and the broker would step into the pit and he would say, hey, I want to buy 10 S&P futures contracts, and the locals would be the ones who would take that order. They would say, yeah, fine, this is what we're offering, and there'll be hand signals and that other stuff, which I think are pretty cool, those things. Go and check those out. There's some guides out there to the hand signals, and maybe it's just me being a market nerd, but I think they're quite cool. Anyway, they would say, yeah, and they would kind of facilitate that order flow, because if it was just broker to broker, unless there was another broker in there, you couldn't get the order done. So these market makers effectively, and they would be compensated, and it wouldn't be compensated like on a fixed payment, but they would, because they had a membership to the Chicago Mercantile in case of the S&P 500, they would be able to do this, and they would be able to kind of take this order flow. Now, what was the edge there? There's a couple of things that not all pit traders were profitable, but a lot were, and there was a lot of stuff to do with, you couldn't just get filled straight away. There'd be a lot of physicality in there, because you've got to be able to shout, you've got to be able to get yourself known, you've got to stand up, you've got to be big and loud and be able to kind of, because you're basically trying to attract attention. So it's not a case of being like the introvert trader and just clicking on the screen and knowing you can get in and out. It's a lot different, but that's by the by. So what's the edge? So the edge is that, hey, you could then, if you saw someone coming in and saying, hey, I want to buy, you could say, hey, sold, and you would make a bit of a spread on them, because maybe the market was a point wide, right, or 2 points wide in those days, and so 2 points wide, a wide market anyway. In other words, not as tight spreads as we do now. Electronic spreads are super tight, but it would be wide, and so then you could hopefully hold that position, have a little bit of a cushion, and maybe hold it for a little bit of a market move in the right direction, and then kind of sell it back, or you could kind of sell it back straight away, and you could kind of be that middleman and take it off that broker and sell it back to them, and making a little slither in between, especially in a fast market where being maybe a bit of panic, broker wants to buy, it's like, I want to buy, and there's a kind of wide spread, because the spread would be made by the pit, okay, and the pit would, and then you could say, hey, I will take those off you, but I will sell those to you. In case of the broker wanted to buy, I will sell those to you, but this is my offer. And it would be kind of really wide offer, and the broker could either take it or leave it. And if they're instructed to execute a market, they would just execute that. And so then of course you've got a big baked in profit, because the actual market's sitting in the midpoint and everything's calmed down. You might want to take an opportunity for the market to rock back and sell it and buy it back your short, or you could just arb it off straight away. And so that was kind of one of the big things, right? Another big edge for pit traders was they would often be brokers as well as locals. And so you'd have this situation where as a broker you would have a selection of cards stacked up, and these would have limit orders put in. And so you'd have, someone who want to do 10 contracts at this level, 20 contracts here, 25 contracts here, 10 contracts, 50 contracts, 100 contracts, whatever it is, and you'd have them kind of in market order level. So as the market got to that point, you would execute that for the client, right? The client would say, and let's use an example, let's say 15,000, okay, a buy, 15,000, and I'm going to do 100 contracts, right? 100 cars, and that would sit there in the stack, and then maybe you'd have another one that says, buy, 40, 90, and that will be 50 contracts, for example, right? So you'd, my writing, guys. I'm rubbish at writing on the board, but it does say contracts. That one says cars, which is contracts. Okay, so imagine you had that. Now those buyers are there, and you are allowed to trade on your own account as well. As the market's coming down, let's say it's trading 15.20, 15.15, 15.10, 15.05. Now it's trading at the figure. You're like, right, it's 1,500. It's not gone 1,500 offer yet. What you could do as a pit trader is buy at 15.01, say, And maybe you couldn't do that, but let's theoretically say you could buy at 1501. So you would go long at 1501, 100 contracts, right? Big position. You take that. Now, if the market bounced off that 1501, great, you got 100 contracts, you might be able to sell at 1510, make a little bit of money, 20, 30 grand, put in your pocket, done. If it didn't, and the market went lower and lower and lower, you can just sell it to that guy, because he wants 100 contracts at 1500. Now you probably could buy at 15 even tighter than that, but you get the idea. The idea is that's your backstop. He wants filling regardless, and you're the only person who's got the order. And so if the market suddenly goes from 1495, you go, all right, well, I'll sell my 100 to him because he wanted them at 1500. And so you've lost one and the chance of making a lot more. And so these games were played. And also you knew there was some support here at 1500 and 1490. You could kind of buy around that higher level, knowing that you could sell it into that if you needed to, and there wouldn't be kind of that much loss. And I don't know if this went on, and I don't know, again, this is the kind of more the intricacies of how it happened, but I can imagine if the price was starting to trade lower, is there an urgency to fill it on that 1490 and 1500? Probably once it's traded through, they will expect to fill. So you didn't have much time, but if it just flicked through and maybe traded a 1495 for one order and then came back, you could arguably say, hey, I couldn't get a fill on that, couldn't get it filled for you. And so this was the type of thing. So you could see where orders were stacked, so you could see where actual support was, literally where support was, and that would hold the market. You could assume that others might have the same as well, other brokers. So if you were going long, you could kind of go long in front of that support, and then you go, right, actually, if that support doesn't hold, I'll just sell it to these guys who are on my list, and I'll give them the fill they want. If it does pop off it, then great, I'm doing okay. Now, of course, the issue is you might lose clients if it does trade at 1500 and they're expecting to be filled 100 contracts at close of the day at 1550. Extreme example, I know. Thinking like, hey, where's my fill? I didn't fill, and you're the one that made some money off it. You've got to be careful how you do this. So this is all legitimate and all fair and all part of the process. And there was obviously fairness in there, and it had to be fair. And it's a capitalistic deal, right? If you're a customer of them and you didn't get the fills you wanted, the price you wanted, and the price would often trade at it, you would use someone else. So you couldn't just constantly rip people off, but at the same time you could lean on people. You could kind of understand where the support was, where the resistance was, where the order flow was, where the stop orders were. Very often, I've told you stories of a number one local would come in, he would know there'd be a lot of stops, sell stops, so they'd have to sell stop in with the broker under a certain level. And if you knew that was going to hit in the market and then it had to be executed, that would create a cascade. You would want to be short into that, knowing that that would create a cascade lower. So they had a much more a much more kind of insight into the order flow and into the market structure and into the bigger players. And also, let's not forget the visual element. So they'll be there, they'll be like, if they had a good position and they were kind of one of the top dogs there, they'd look around and they'd see Goldman stepping into the pit, who they knew was just an order filler guy for Goldman. And if he had a panicked look on his face, and they would say this, you speak to the pit traders, they'd say, hey, at the open, we thought, hey, we can look around and I can read their faces. Like, these guys are looking frightened. We're already opening down, gapping lower, and I'm seeing someone step into the pit who I know works for Merrill, he works for Goldman, he works for Shears, whatever it is. All of a sudden, like, this is opening lower. I'm going to make sure that I'm selling immediately open because these guys have probably got big clips to put through. And so there was that. They could see their facial expressions and judge from that whether that person had a lot to sell, was nervous, or whatever it was. And they could also see it from their fellow pit traders as well. Whilst I'm sure there's a lot of camaraderie going on, there would have been a lot of cutthroat things as well, and kind of, okay, listen, I know we stuck short on this, so we ain't buying, we'll let this thing roll over. We know there's a big seller there coming in, or big buyer, sorry, if you stuck short, there's a big buyer coming in, and we're not going to let him out, right, until he needs to get out of it. And so I'm sure there was that kind of stuff going on. It was being able to see your participants. It's like playing poker to a certain extent. One of the edges of playing poker in person is you can see the person's face, right? You can see the bluff, you can see the panic, you can see the fear. Same with the pit. If there's someone coming who's panicking about something, the market's heading high, he's stuck short. And so it's going to come in with a big buy order all of a sudden. So let's use a hypothetical example, real world example, right? You're there, market's chugging along. You see the market's chugging higher, 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 higher. You see Goldman coming in, maybe a little bit of fear on his face. You're like, hey, that looks like why is he worried about the market going higher? Is he trying to get, is he needs to buy quickly? Is he stuck short? Is someone panicking and needs to buy? Or is there a kind of, he's worrying he's not going to get a good fill? And so you kind of decipher this already. And before he steps into the pit, you're like, yeah, buy 100, buy 100, buy 100, buy 100. You would buy those 100, you'd wait. If he comes in and starts bidding for, 500, 100 or whatever order of magnitude at these high levels, then you're like, great, I'm long, and he's buying as well. So there's like a bit of a roar in the pit. Market pushes higher. You're already long. You can then maybe sell it to him as it's pushing higher. You can go sold, or you can see his urgency, and you could sold and make like a quick spread on it. And so this type of stuff was always going on. So quick answer to this question: can you recreate a pit trader's edge on the screen? No, I don't think you can. I think that's why a lot of floor traders struggled to transition to electronic, because they didn't have that edge. They didn't have that stack of orders. Some of them did, some of them didn't have those, but they couldn't see the players. They couldn't see and feel the buzz. They couldn't sense the energy. Couldn't sense the, and also they'd say things like, as a market roar, big roar, as it's kind of running through highs, big roar and all this, and then it would go quiet. That's the top. That's exhaustion. You can smell it. You can hear it. Sure, it did smell in the pit sometimes as well, but you get the point. It was like you could see the exhaustion. You could hear the exhaustion on the chart. You're trying to decipher it in the candle and the tape. Like, oh, is it there? Is it not? A little bit harder. So, big edge in the pit for the pit guys. Did very well out of it. But that was the game at the time. They were there to provide a service, and quite rightly, they've been compensated for that service. There was arguments to say various things in that. Not interesting. Get involved in that. I just think it's a cool bit of history and part of trading, but I just don't think we can recreate. Maybe there's elements of it you could potentially recreate. Be interested to hear your thoughts on that one, guys, in the comment section below. But all intents and purposes, I think it's long gone. We've got to carve out a new edge, new era for trading. Plenty of edge on there. It's just a different type of edge. Take care. Keep your risk managed. I'll see you in the next video. Bye bye.